for all new investors to give everybody a chance to learn more about the asset class and then our approach to the asset class. And so the first part of this presentation is going to be talking about farmland as an asset class. The second part of the presentation is going to be talking about AcreTrader's approach to the asset class. And so I'm going to move us along here. So the first couple slides here are some important disclaimers that we want to be able to touch on as we walk through these slides. All of the offerings that you see on the AcreTrader platform are securities that are offered through North Capital Private Securities. And you can see all of the legal disclaimers here. Again, more disclaimers that our legal team has certain compliance has certainly asked. All of these are investments. Investments do involve risk. Every single offering that you see on the AcreTrader platform does have a PPM that is available for download that will walk through all of the individual risk factors for that individual investment. And again, there's a Q&A, so please, for any questions that you have, please input those in the Q&A here, and we'll save time at the end to answer all of those. So I'm also going to turn off my video to allow you guys to see the screen better here and not have to look at me. So the first point here, there are multiple factors as it relates to farmland as an asset class that are important to consider, and we're going to go through a lot of these in the upcoming slides. The first is the appreciation of farmland values over time as a result of shrinking supply and increasing demand. Second is the relatively low volatility of farmland and the downside protection that it can provide due to its historically low correlation to economic events, economic uncertainty, political events that are relative to farmland values, and then just the low vacancy risk of investment grade farmland. Third is the diversification that farmland provides and the ability to reduce risk with a less correlated asset class. And then finally, farmland is an underinvested asset class. And when you combine better data and unique sourcing, it can present opportunities. So first, talking about the supply picture for farmland. So there are now a little over 382 million cropland acres in the United States. We've lost almost 63 million acres since 1997, according to the USDA census data that's conducted every 5 years. So over the last 25 years, we've lost almost 5 acres of farmland in this country every single minute. This is a critical point. No amount of money can increase the supply of quality cropland in this country. Now, relative to that shrinking supply of cropland is the increasing demand on that supply base. And this is represented here as the global demand for food over the coming decades. The global population is expected to add another 1 billion people over the next 2 decades. And as incomes rise, so does calorie consumption per capita, and also the type of food that is consumed as developing economies become more developed. That puts, again, increasing pressure on this supply base. So this slide is a little busy, but it is meant to provide a proxy of returns by asset class. Some of these are indexes that you can actually invest in. Others, such as the NC Reef Index for farmland, for timberland, for commercial real estate, are representative indexes. And again, this is meant to provide a comparison of a broad portfolio of assets on a comparable basis, and it's not representative of any individual property or individual stock or individual bond. So while the S&P and equities have provided very attractive returns, 12% on average going back to 1990. It does also include years of significant losses and has shown greater volatility. This really holds true during periods of inflation, where during times of inflation, which we're going to touch on, we've seen real assets outperform financial assets. This is something that we saw in 2022, where the S&P 500 total return was down 18%. Treasury bonds during that time frame were also down 18%, and AAA bonds, investment grade bonds, were down 13%. The traditional 60-40 portfolio of stocks and bonds was not able to provide the diversification during this inflationary period. Farmland, according to the NC Index, was up 9.5% in 2022 and up almost 17% according to the USDA data. It's important to understand how liquidity factors factor into volatility. Private assets, whether we're talking about farmland, timberland, private equity, or infrastructure, are typically invested in and accessed through vehicles that require long-term capital commitments, typically 5 to 10 years. These are only revalued quarterly or annually, and therefore they are less likely to be subject to swings in reported value. So this lack of liquidity is a key consideration, and there's a correlation between asset classes that carry low liquidity and those that carry higher levels of lower volatility. This slide here really talks about returns in relative to risk. You can't talk about returns without also talking about risk. And this is one way to frame risk in terms of volatility. So as you can see here, farmland average total returns have compared favorably to other asset classes, such as stocks, commercial real estate, and REITs, and they have done so with less volatility. The NC Farmland Index has provided 10.3% average annual total returns with approximately 7% volatility. The only index that has shown lower volatility is CDs. This is especially notable today. So the data that you've seen here all runs through year-end 2024. So as of December 31st, 24, as of today, the S&P 500 has fallen almost 10% from its highs just in weeks ago in mid-February. So here you see farmland's historical correlation to other indexes. Farmland can serve as an important diversification tool for investors, given the fact that it shows little or negative correlation to other asset classes. And this is particularly true as it relates to financial assets, such as stocks and bonds. You see those at the top of the chart here. Farmland is negatively correlated with all of the financial assets listed at the top here and shows very little correlation to assets such as gold and REITs, and some positive correlation to commercial real estate and timberland. However, it's still not statistically significant. So this graph shows the value of cropland in the United States historically, according to USDA data. And please note that this is the underlying land value or the asset value, and this excludes any sort of income returns from the land. So this is not the total return of farmland. This is just the value of the asset itself. And one key point here is that historically, farmland has proven to be a store of value in times of both economic and geopolitical uncertainty. Over the last 27 years, through geopolitical events such as 9/11, the Arab Spring, the Russian invasion of Ukraine, economic events such as the dot-com bubble, the great financial crisis, the COVID-19 pandemic, farmland values historically have remained resilient. Here we're looking at regional asset total returns. So this is a different data set. This is using USDA data to show representative aggregate returns by region. So each year the USDA provides county, state, and region level farmland values based on the survey work that they do. And they also provide cash rent per acre. So here we show the year-over-year change in farmland value to represent appreciation and the cap rate based on cash rent to represent total return by region. This includes all cropland acres, so it does encompass marginal farmland all the way up to Class A ground. And what you see here is the return profile is similar to the data that we just looked at in the NC REIF index. Total average annual returns here have ranged anywhere from 7 to 12.3%, with volatility ranging from as low as 2.8% to as high as 8.8%. This data set dates back to 1997, and so it's representative of the last 27 years. That's as far back as it goes. And in total, the index overall has shown average annual appreciation of 5.8% for U.S. cropland in this country. So the impact of inflation is a key consideration for, any long-term investment. This chart shows the annual year-over-year change in CPI, so the Consumer Price Index, compared to the USDA's data for land values for the 32 top producing agricultural states in the United States. Note this is just the change in farmland values. So again, it excludes any kind of income from the land and is not representative of total returns, only asset value. Key takeaway here is that farmland values have shown a 0.67 correlation to inflation dating back to 1911, which is as far back as we have data for this data set. Also note the green line that you see here, that represents the change in values of farmland on a year-over-year basis. It tends to move at a greater degree than that of inflation. So historically, farmland has increased at a greater degree than inflation, and that's an important point as we look at this next chart here. So really this shows why inflation matters. Here we use the USDA data, and then we also use data compiled by NYU to show the real returns of various asset classes, again, on an index level. So this takes the annual returns and it adjusts for the impact of inflation. And this is why high correlation to inflation is so important. As shown here, accounting for the impact of inflation, farmland has demonstrated relatively strong real returns. And this is also why it's important to understand and consider capital appreciation and not just look at yield. Farmland is not a yield-based investment. The vast majority of returns for farmland historically has come from the appreciation of the land, just in the same way that the vast majority of returns for stocks have come from capital appreciation and not just the dividends. And to put it in an example, the current yield on the 10-year Treasury is 4.3%. The latest CPI report this morning was 2.8%. That would put the real yield after adjusting for inflation at approximately 1.5%. So inflation really erodes the purchasing power of a fixed income instrument such as a bond. So if you have, $1,000 bond at par value and inflation is running at 3% a year, after 1 year, that bond is going to be worth a little less than $971 the following year. So this impact is something that only compounds over time, whereas assets that have a positive spread to inflation, the situation is in reverse. Farmland values are positively correlated with a positive historical spread to inflation of 1.16%. So this is a pretty standard chart here, but trying to understand, convey a key point when you think about investing in farmland. This is kind of the framework to think about potential farmland returns. These should, be considered against the risks that we discuss, here in this webinar and that are listed in the PPM for any offering. Farmland returns are driven by three key factors. Like we talked about, the appreciation of the farm during the hold period. Secondly is the annual cash on cash distribution back to investors, which is defined here as the net cash from operating activities as a percent of the total capital invested. And then three is the initial farm purchase price relative to market and the exit relative to market. So as you think about distributions, each year, investors receive a distribution that is based on the lease income from the farm after covering all the operating expenses and paying property taxes. That's the annual cash yield component. When the farm is eventually sold at exit, investors receive any appreciation or depreciation in the value of the farmland. So this is the capital appreciation component that we just talked about on the last slide that is so critical when you think about the overall returns for farmland. Again, it is not meant to be a bond replacement or a fixed income replacement. It is a real asset that has shown capital appreciation over time. So we've talked, we just mentioned how the USDA cropland has increased 5.8% on average annually across the country. The annual that's a decent proxy to consider for market level appreciation. The annual cash on cash distribution rate to investors is based on the annual lease income less the operating expenses and property taxes. That can be reviewed in the PPM and the financial model in the document section of the offering page for all of our offerings. We are strong believers in full transparency. We put up the financial model for every single offering on the platform, and it is all listed in the PPM as well as a full discussion of returns and how to think about returns. And when you combine the projected annual appreciation plus the annual distribution rate, you get a rational assumption for the potential annualized return of any given farmland investment that you see on the AcreTrader platform. The ability to deliver returns above or below market is going to be contingent on the ability to buy investment grade farmland below market and sell it above market. That's the third key factor to returns that really ties into our specific approach here at AcreTrader, which we're going to touch on now. And please keep putting in questions, and I'm certainly going to answer all of them at the end. If I run out of time, I will absolutely answer everything on an individual basis. But please, the more questions, the better. So now touching about AcreTrader's kind of approach to this entire asset class. And so historically, this has been a very difficult asset class to access. Really, it's been historically only for the largest institutional investors because of the scale that is needed. The minimum capital needed to acquire what would be considered an investment grade farm is typically going to start at a minimum of $1 million purchase. And even then, you're going to significantly lack diversification. And your ability to build an entire portfolio is going to be very limited unless capital is not an issue. So this is one of the biggest initial barriers for farmland investing. You compare that to, say, someone deploying $1 million on the AcreTrader platform, that would allow that individual to invest in anywhere from 60 to 70 farms. In addition to being cost prohibitive for most investors, direct ownership of farmland is not passive at all. It takes a lot of expertise to manage farmland. That includes really understanding the underlying value of the farm itself, understanding the local operator market, identifying operators and good operators to work with, structuring and managing leases, identifying and then implementing any value-added improvements, and then ultimately identifying attractive exit opportunities throughout the hold period of that property. It is certainly not, on a direct basis, a passive investment. So the AcreTrader solution is really as follows. So our team will identify what we consider to be, an investment grade farmland. We execute, thorough due diligence and valuation work on that farmland. We look at well over 1,000 properties every year in detail, and we make many offers, and most of our offers are not accepted. Less than 5% of the opportunities that ultimately make it through our initial screening process then actually even move to the offer stage, and it's an even lower percentage that is actually executed on, because we want to make sure that we're always buying ground at or below market value. That's key for delivering returns. Once we identify that opportunity and we actually do get it under contract, if we're successful, we place that farm, or we'll establish a unique LLC, or in some cases an LLP, whose sole purpose is to hold the title to that land and to own and operate that farm. Investors invest as members into that entity. AcreTrader Management serves as the manager to that entity and is responsible for all farm management, all administrative work, all reporting, distributions, and ultimately disposition. And our approach to disposition is, we believe that if we're holding a high quality asset, we need to wait for a motivated buyer who's willing to pay premium for that asset. And that is how we can ideally optimize returns for investors. Thinking through the diligence process, that's obviously critical for any investment opportunity. This is only a portion of the work that is done. It's important to remember there are no homogeneous assets in farmland. Every individual asset does come with unique considerations for that farm, and really no two can be considered exactly the same. Many times farms across the road from each other might trade for radically different values based on the soil type, or if you're in the Western United States, the water rights. So we kind of divide our diligence into intrinsic and extrinsic considerations. So that intrinsic diligence is really, gaining a thorough understanding of the soil, the water, the drainage, the historical production, the on-site infrastructure, what kind of value-add improvements might need to be enacted during the hold period of that property. And then the extrinsic diligence focuses on the regional market that the asset is located within. That's, an assessment of weather, climate, local commodity markets, access to markets, tenant density is critically important. And then we spend a significant amount of time on data, which we're going to talk about here, and understanding farmland values in a local market to a very micro degree, because that is how you can understand if you're getting a relatively attractive farm or not. Finally, once we do all that work, our boots on the ground farm managers go out to the property and ground truth everything to allow us to obviously further complete that diligence process. And once that's all done, every deal then goes to approval to our investment committee, which must unanimously approve that offering before going onto the platform. So I mentioned the data earlier. We really think the AcreTrader platform combines really three key attributes to deliver performance for investors, which is data and its access and its expertise. We've mentioned our expertise a little bit, and we're going to touch on our team here in some upcoming slides. The data component really comes through our sister company, which is Acres, which is also owned by AcreTrader. That is, think of it as almost Bloomberg for farmland. It is an in-house data platform through a mapping interface that we developed and then has since turned into its own standalone business in and of itself. That data can drive better decisions. Timely data and access to data is really critical because there is no MLS for farmland. You can't just go look up and say, okay, here's what the farm down the street sold for, and here's the attributes that make it comparable, and here's the attributes that make it not as comparable. That information has been painstakingly put together by our data science team and our farm team, and a lot of the members of the AcreTrader team over the last 7 years, really. And we really believe that is a muscle that we're quite proud of now. So one other unique aspect for us is sourcing of opportunities. We not only connect investors to farmland as an asset class, but we also connect farmers to investors. By nature of our business and existing on the internet, we are very, very public facing. You don't see that with other farmland investment platforms. This very public marketplace that's been created over the last 7 years has and continues to create a lot of inbound leads from farmers. Our farm team's been doing outreach for years, developing relationships in the core regions in which we operate. And this is really unique to our business. Our industry is also unique. Tenants bring us deals. That's because they have real costs in their business. They have real economies of scale in their business. They have real capital barriers that we mentioned earlier that everyone faces in terms of purchasing farmland. And if we can create a structure that is win-win for both farmers and for investors, that has proven to be a very big strength for us. So for an example, when a farmer is looking to sell a parcel to unlock some equity from their operations to maybe pick up some additional acreage, they may want to sell ground but not lose operational control. Given it'll vary by market, but typically about 70% of the farmland purchased in this country is purchased by farmers. So if I'm a farmer and I go to publicly list my farm for sale, the likelihood is that another farmer is going to buy it and I am no longer going to farm that farm. They can reach out to us, and if that farm meets our diligence criteria and meets our valuation criteria, we can then enter into a long-term lease with that operator, and we will certainly do much longer-term leases than most other landowners are willing to provide. And we will try to find mechanisms to make that structure a win-win for the farmers themselves. And so that has proven to be a very powerful sourcing mechanism for us. So I mentioned the index level or broad asset class returns earlier. Again, historical market rate total returns for farmland have been in that kind of roughly 10% range. Whether you look at the USDA data or the NC Reef data, that encompasses something like 6% appreciation and something like 3 to 4% annual, yield or cash on cash return. That's the way to kind of think about that breakdown. The third component, though, is being able to buy farmland below market and ideally exit above market. And so this is a very busy chart, but this uses actual acres data where we looked at transactions from 2018 through 2023 for this exercise here, and just basically said if you purchase farmland at the 25th percentile versus the median versus the 75th percentile, what kind of impact on just the appreciation of the land alone would that have on your returns over time? And it's while it's a busy chart, it's a very intuitive point. You want to be able to buy low and ideally sell high. Here we only show that if you are able to buy at the 25th percentile and sell it in market, that's going to add another 160 basis points, so like 1.6 percentage points of annualized return to your performance over time. Conversely, if you're buying above market at the 75th percentile and then just selling at market, based on this is actual transactions and actual data, you would have underperformed the market by 260 basis points annualized, or 2.6%. So this is very important in terms of delivering alpha, which is performance above market average. And this is where we believe we have a strength. And it really shows in this chart. So this is, again, the same data. This is looking at Class A farmland transactions in Illinois versus our Class A purchases in Illinois over time. And this is looking at it on the price per tillable acre based on the soil productivity of the farm. And so this is the way that you can make it as apples to apples as possible. Again, this is not a very homogeneous asset class. However, these are 6 counties in central Illinois that are as homogeneous as possible, in our opinion, for farmland, given they all grow very similar crop types. They do carry very similar soil types, and we have isolated this down to a certain productivity index of the soil to make this as comparable as possible. And the dark green transactions are the dark green dots that you see are AcreTrader's purchases over the years. So this is what we've actually done. This is not survey work. This is compared then to these other transactions that we have in our proprietary database, which is as encompassing as I believe is out there. This show right here is approximately 1,000 transactions over this time frame. And so we do believe that we've shown the ability to execute on our model in order to deliver returns for investors. So key takeaway here, just to highlight, is that we really try to combine, farmland experience with big data. We built Acres to give us an unfair advantage, frankly, in identifying, reviewing, and valuing acquisitions. Having a database combines, millions of transactions, mortgages, geospatial records. It gives our team significant access or asset and market visibility for every deal. And then when you overlay that with our sourcing network of local farmers, local farm managers, and also local brokers to a degree, this allows us to review more opportunities, in more detail faster. This is, the real kind of coming together of how we kind of view our approach to the market. So AcreTrader management has sourced, funded, and managed over 140 farmland investments across the United States. So, we have, over the last 7 years now been able to really provide a lot of investors access to this asset class in a diversified and passive manner, and build out portfolios across the country with diverse farm types. So again, kind of touching on our AcreTrader management approach, 140 deals through our platform has really taught us a lot. We built a lot of muscle around that knowledge. Managing over 40,000 acres involves a lot of in-house as well as very local expertise. We actually pay a portion of the annual management fee that we take directly to the local farm manager who visits the farm many times per year and helps provide that local objective agronomical expertise that is needed in order to properly manage these farmland assets. And every investor that invests on the platform does receive mid-season reports, end-of-season reports, end-of-season financials. Just last week, we sent out over 10,000 K1s to investors. very much on time, and very proud of that. And so this is kind of what you can expect from both the initial upfront to the after effect experience and working with us. And this is the sourcing team, not does not encompass also the asset management team, but just the sourcing investment team here at AcreTrader. Myself, three other colleagues, and you see a lot of individuals with a lot of experience here, from both finance background and from agricultural backgrounds, and data backgrounds. And so we're quite proud of the team that we've encompassed here. So we have seen a number of full cycle investments. We are still a relatively young company. The first farm went on the platform for AcreTrader back in 2019. And again, we've funded 140 farms since that time. So far, 15 of those farms have gone full cycle, meaning they've been exited and sold, and that capital, both the return of capital and return on capital in the form of appreciation and income, as discussed earlier, has been returned to investors. And so what you see on the right here is the net actual IRR for the 15 offerings that have been completed to date. And when you look at the range of outcomes here, it is ranged from as low as 9.4% actual net IRR after all fees and expenses back to investors, 9.4% to a little above 30%. So far, we're quite proud of the track record that we've been able to put together here at AcreTrader, on the AcreTrader management side. This is, cumulative investor returns of over $25 million. So we're proud of the fact that each 15 of these investments outperform the initial underwrite. So with that, I'm going to jump over to questions. And so the first question is it possible to get copies of the presentation and slides? Absolutely. We will provide that after this to everybody that signed in and would like to see that. The next question is the annual, and also my colleague, Rob Moore, who had to step out for personal emergency, has back joined me to help answer these questions. Next question here is the annual distribution is based on cash rent income minus operating cost. What is included in the operating cost? Very explicitly, I would encourage you to go to the document section of the offering page. There's an offering on the platform now. You go to the document section and you can download the financial model, and it will give it to you in Excel and explicitly list out those operating costs. Now, generally, those are going to be the accounting expenses for doing the annual accounting for that entity. We obviously have an outside CPA firm provide accounting for each individual entity of the 140 plus that we manage. That will also include the asset management fee paid to AcreTrader, which is that 0.75% annually. And again, a portion of that goes to paying our farm managers for the local farm. And then property taxes will be the largest other component of that. So we're very big believers in keeping things low cost. And we believe we've been able to execute on that quite well to date.
There's a question here about what type of entities can invest, and you can invest through an entity. Obviously, it needs to be a U.S.-based entity. We only accept investments from U.S.-based citizens, residents, and U.S.-based entities. You can use an entity. You can also use an IRA. There's a question here about an IRA. You can use a self-directed IRA. There are 3 custodians that we work with on the SDIRA side. That's InTrust, Equity Trust, and Alto. So those are the 3 compatible IRA custodians that we can work with. There's a quick question on leverage. There's no leverage used when acquiring these farms. These are unlevered farmland investments.
Yeah, there's a good question. So I should look at this investment as, the annual distribution is more or less a dividend, and then the real return is when the property is sold. I think that is a good way to look at it. And the way you can maybe think of it most simplistically in your head is the historical average appreciation for farmland has been 6%. It's going to vary by farm, but the typical net cash after expenses to investors annually from that dividend component, that income less operating expenses, is going to be something like 3%. And so an annualized return of 9% is a very good proxy to think of based on what we've seen historically in the data. And that's also supported by the USDA data total return that we looked at before that was 9.5%. And then the NC Reef data that we also looked at, a different data set that showed 10.3% annualized returns.
There's a question here about liability. We do carry liability insurance on all of these entities. So if you think about it, we're functionally managing from the AcreTrader management side 125 actively, 125 small businesses. Those do all carry liability insurance. We also, within our lease agreement with the local tenant, mandate that they also have insurance as well. So there's several layers of protection there regarding potential liability for the question is related to a potential injury on the property.
You want to answer the one about accreditation verification?
Yeah, so there's a question here about accreditation verification. There's a couple of different ways that you can be accredited for investing. So the first one is by annual net income. The second one is by net worth. In the net worth, the verification currently is due every 3 months. There's a question about that expiring. The SEC has been fairly explicit in the overarching rule on how to handle accreditation, what documents can be used, how recent those documents must be. We're always reassessing and looking at updates that come out of both FINRA and the SEC, and it's certainly our goal to make it as easy as possible. So anytime where we can extend the accreditation verification for up to a year, we certainly will. Right now, that is allowed for accreditation by income.
There's a question, how many AcreTrader properties, if any, have incurred a loss when they were sold? We have not, all of the exits that we showed you are all of the exits for AcreTrader management that are managed by us, AcreTrader management. And so of those 15 exits, they have all shown performance anywhere from a net IRR to as low as 9.4% to a little over 30%. So no, none have been sold for a loss.
Yeah, there's very, very rarely, there's a question here about fallowing land, and none of the assets that we have put on the platform or offered for investment are farms that are in a fallow rotation. So everything is going to be planted on an annual basis. Typically, there's a rotation in that planting schedule. So to reduce disease and pest pressure in particular, most farms are going to rotate between crops on an annual basis. In the Midwest, you're going to see that traditionally be corn, soybeans, corn, soybeans. Down here in the Mississippi Delta, you have optionality for rice and cotton. You see some sweet potato growth down here as well. And the Carolina coastal plains, so this would be Georgia and North Carolina, eastern half of North Carolina. You could add in peanuts to that rotation. And then we do quite a bit of work out in the Pacific Northwest. There you're going to see sugar beets, onions, and potatoes as well. So we focus on underwriting farms in what we consider core regions. So we want high quality, generally A and B quality soils. We want these, what we define as institution grade or investment grade assets. The way we think about that is we want there to be a secure market for that. So you're not going to see us investing in acai berry development in Utah, right? We're focused around the Pacific Northwest, the Central Valley of California, the Corn Belt and surrounding areas, both Nebraska, the Red River Valley, the Mississippi Delta, and then the Carolina coastal plains. And that tracks with our thesis of looking for the lowest standard deviation. We don't want large variability in expectation. We want to put forward a fairly homogeneous product with the ability to diversify across both region and crop type.
So there's a question, what happens if the capital needed for acquisition is not reached by the termination date? Example, the St. Francis farm that you see needs approximately 2.2 million with the termination date of June 27th. So we have never not funded, or English there, but we've always funded anything that we put on the platform because we are trying to meet a real estate close of escrow. And it's very important for us and our reputation in the industry that we're able to close on anything that we say we're going to close on. And so we manage that very carefully. We're very mindful of the offering sizes that we do put on the platform. As far as your investment, when you subscribe and invest in an offering on the platform, your dollars will be then held in a third-party escrow account at North Capital Private Securities, which is unaffiliated with AcreTrader. We never touch the funds. It goes to a third-party escrow, and it is only allowed to be released from escrow when either the offering size minimum is hit or those funds are returned back to investors if not completed. And so it is all held by a third-party escrow, and the explicit instructions are all in the PPM. We cannot deviate from that.
There's multiple questions here about typical life cycle or length of an investment period. And you'll see on the platform, we're traditionally advertising a 5 to 10 year hold period. Again, it's variable on purpose. There is a liquidity premium for farmland. You do not want to be a forced seller in any real estate investment, certainly not in farmland. So our focus is on making sure there's some variability there. If you look at our exited deal cards, you'll see that most of those offerings are on the earlier side of that. Several of them are before 5 years. The way we think about our fiduciary responsibility to investors is, and again, we have 15 exits, we have over 120 actively managed properties. We are a very public facing company. It is rare that we go a week or two without getting an offer on some property within our portfolio. If it's outside of that 5 to 10 year hold period, it needs to be a very compelling offer for us to move to exit early. However, again, because of our both network, local network, our broker network, and then our public facing, being a platform on the internet, we do receive a lot of unsolicited, compelling offers. So this often comes out of the 1031 space. Sometimes the current tenant will reach out and say, hey, I'd be interested in buying this. I have the capital available. If that offer is compelling and what we believe to be top of or above current market conditions, then we have exited early. So our goal is traditionally to aim for a 5 to 10 year hold period. Of the exits we have on the platform, the vast majority of those were unsolicited, compelling offers that we decided we had a fiduciary responsibility to return those funds to investors.
There's a question, is there an option to invest into multiple farms in some kind of a fund structure? And then what are the liquidity options? The answer is we have many investors who will build a diversified portfolio across regions on our platform. And that is, there is no fund structure. We've explored that many times. And what we find often is when you try to layer in a fund structure to something like this, it adds in a lot of costs and a lot of fees for investors. It does make it easier, but many of our investors build a diversified portfolio and invest multiple times in multiple farms all across the country. As far as liquidity, please keep in mind these are long-term investments. And so each individual farm, you'll see the targeted hold period listed in the PPM, but generally those are going to be 5 to 10 year hold periods. And so the liquidity is very, very limited until the farm is exited and then the capital is returned. So these are very long-term investments.
There's a question here about how we assess potential needs for additional investment to improve a property, which is an excellent question. We do that upfront during our diligence. So you will routinely see in the financial model for offerings on our platform, additional capital being set aside to improve the property. The example in the question is drainage tile, which is certainly the most common form of improvement budget we use. In the Delta here in Mississippi, Arkansas, and Southeast Missouri, we'll do land leveling projects that, from our standpoint, any opportunity for us to increase the value of the property is usually worth investing in. And again, we're running a financial analysis to look into that. We also want to make sure, even with that improvement budget, the fully loaded cost to investors is in line or below current market rates. It's really important for us that we are assessing this in the dollars into investor pockets. The IRR numbers that you see, realized IRR in our exit PDF, are actual IRR net of all fees directly to investors. We think of the same way with improvement budgets. So if we can get a property a certain percent below market and have room to improve that asset, we typically will. That's almost always less than 5% of the total capital raise. Usually it is 1 to 2% of the total capital raise. And again, our focus is going to be on irrigation, so getting water onto a farm, and then removing water. So grading and drainage tile to then remove excess water from a property. Those tend to be the two most important factors when looking at how a piece of property is going to be de-risked to maximize production and then obviously long-term value.
And I note that any improvements are also listed both in the PPM and in the financial model. So you can see if we're going in and adding tile drainage to a property, what the budget is, and we'll review all of those improvements as well.
There's a question here about organic led crops, and certainly we're very interested in those. We've done several, both organic, so standing organic, pre-converted properties. We've also done several properties or offerings where we were working with an operator to transition that to organic ground. The organic transition property, depending on previous use, is going to take typically 2 to 3 years. During that time period, a farmer is functionally farming organically, but having to sell their crop at a traditional or conventional price because it's not certified yet, which makes it very, very difficult from a cash flow standpoint. You're spending all of this money to be organic. You can't put down fertilizer to maximize yields in the same way, but you have to sell them at the same price of people that are.
Our model works really well with organic transition farmers because we're willing to take a lighter rent on the front end, and we can do a longer lease agreement. So then they have the security to know I have a 6 or 7 year lease where I'm going to pay less during the transition period, and then that rent escalates after the organic transition is complete. We have successfully worked with farmers on that model on quite a bit of ground. Now, I will say organic opportunities are very rare only because of the percent of total ground that is in organic production is still extremely low nationwide. And as a result, I think our percentage of organic properties is far larger, the percentage of our portfolio that is in organic compared to overall farm ground. But those opportunities are more rare. I would say traditionally you're going to see a organic offering from us anywhere from 1 to 5 times a year.
Yeah, less than 2% of the cropland in this country is organic. And the question also talked about trends, and that trend has been flat. There has not been a significant increase in organic cropland acreage.
It's a question about being able to select specific properties. All of our investments are specific. So each entity will only do one thing. It will be opened, it will own and manage one piece of property, and then it will sell. When it is sold, we will then dissolve that entity. So most investors on our platform are investors that want to build their own portfolio, right? They're thinking through, you get the empowerment to decide where you want to put your money to work, both regionally, crop type, what type of investment. Is it a value add? Are we improving that project, or is it simply high quality farm ground at a good entry price? And the investor can then build out a portfolio over time. So many of our investors are invested in 10, 20, 30 different offerings, and then you can sort of tailor that to what fits for you. So if you are more interested in a certain region or crop type, then you get to wait and decide how you deploy your capital.
This question, do employees at AcreTrader invest in all of the investment offerings, or does AcreTrader invest in the investment offerings? AcreTrader does not take a stake in any of the investment offerings that you see in the platform. From time to time, several employees here at AcreTrader will certainly invest in offerings historically.
Yeah, and we're a couple minutes over time, so we'll answer one more and then move on. There's a question here about things that we look out for on the regulatory front and how that approaches or changes our thesis. And I think it's really important for us. We actually just published a very large article in our Learning Center, 2025 Farmland Outlook. It would absolutely point investors to review that. That is a very, very up-to-date and poignant article that we put out specifically to answer this question. We get this question a lot. Historically, farmland values have not had political opinions, right? Farmland values have, if you look over the 50-year history or trend of farmland values in the United States, they tend not to ebb and flow with political decisions. And realistically, our entity and structure is largely built to insulate investors from that. All right, we want to insulate investors both from the downside, but also from the upside, right? We want the farmer to be responsible for their business. They are going to do well in really good years. Investors are focused on the underlying asset. So you are investing, and yes, there's cash flow from that farmer, but that is not the focus of the investment. The focus of the investment is on the long-term appreciation of American farmland.
Yep. Any of these, we got quite a few more here. So we'll answer each of these individually. You'll receive an email from us. And please, if you have additional questions, phone numbers here, info at AcreTrader, go to acretrader.com. It's very easy and obvious in how to get in touch with us. And we always appreciate questions from investors. And thank you very much for your time today.
Appreciate it.